Good morning from Hamburg. Basically, this Monday we decided to continue for the next 7 days to avoid the Red Sea and the Suez Canal and go through the Cape of Good Hope. That means much longer travel times and, of course, additional cost.
Nils, it does mean additional cost, but I presume the insurance for certain acts will go down aggressively for those shipments as well. And I've got to be brutally honest with you. I've taken a look at your share price and the sector's share price since the start of this awful crisis. And that is the backdrop, of course. Your shares are through the roof since middle of December as well. So, yes, more costs, but you're passing on all of those costs and more, aren't you, sir?
Well, we're passing on the cost we are having. You just have to imagine that when you go from Singapore to the East Med, which normally would be like 10 days, will now be 18 days longer. So this is 3 weeks more fuel consumption. This is 3 weeks more using of the vessel, 3 weeks more travel time for the cruise. So this is simply something which you have to pass on to the customers.
And then some, though, because it would appear from, again, the industry's share price and the fact that shipping container rates are up somewhere in the region of nearly 200% in some cases, that there is an accusation that the industry is not only passing on the costs, but actually passing on more than the costs?
I don't share that view, a few years ago, or let's say 1 year ago, share price have been still very high and share prices have gone down a lot in the last weeks and months. And we were facing, again, a time like pre-COVID, even less than pre-COVID. A container from Hamburg to Singapore in the last months was like $100. And a container which normally from Singapore to Northern Europe was like 1,500 was below $1,000. So, this industry has faced a lot of downturn in the last weeks and months. And I think this is just going back to normalcy. It is not that, we are making our pockets full.
Nils, away from price, there are also concerns about the impact on supply chains. And by numbers, 20% of the world's container ships are avoiding the Red Sea. This according to the International Chamber of Shipping. There was a view as this started that the longer this went on for, the more impact on supply chains that have been repairing since the COVID pandemic. What impact are you now expecting?
I don't really see that as dramatic as we have seen the situation during COVID. We shouldn't forget that COVID was a global crisis and that we have seen disruption of the supply chain on a global base. What we are now seeing is more like, I shouldn't say a local crisis, but it is more when you look at Far East Europe, when you look at Far East US East Coast, yes, this has a huge influence. But this will mean delays, and this will mean some congestion, perhaps in some selected ports. But it is by far not the same situation as we have faced the last 2 or 3 years.
What's the ESG impact? We know the industry has been pushing in one direction thanks to regulation, but as we're talking about longer sailing times as well, there must be ESG consequences.
Yes, there are consequences, but on the other hand, there is lots of capacity. During COVID, many shipping lines have ordered new ships. All these ships are now coming into the system, and there is enough capacity to deal with the demand and to compensate the longer travel times we are seeing. I would not expect that we are running out of capacity in the next 2, 3, 4 months.
Can I ask you about the approach now from the US, UK and other Western countries that have been threatening to push back against Houthi rebels with direct attacks? So far, they've been shooting down missiles, but now the escalation they're talking about suggests there could be attacks on some of the Houthi rebels themselves. How hard would this be to achieve, and would it actually bring any de-escalation by having a more of a hot conflict at this point?
Very difficult to say. We are not politicians, but what we can say for the moment, we don't seem the passage through the Red Sea and the Suez Canal safe. We had an attack in December. You can imagine how hard that was, not only for us as a company, but especially for our crew. There were several attacks in the last days, and as long as the passage through the Red Sea and the Suez Canal is not safe, we won't pass.
Nils, whilst we've got you, if I may expand the conversation just briefly, mate, to the broader outlook as well. We're all waiting to see whether the stimulus efforts from the PBOC, from the Chinese government, are actually going to meaningfully shore up the concern that we all have, and I'm sure Hapag-Lloyd has as well, about flows in and out of China and the industrial activity there. What's the latest as far as you can see in terms of the Chinese recovery?
Well, what we are seeing right now, we are running into the Chinese New Year. So before Chinese New Year, there's lots of demand, of course, out of China into Northern Europe and also into the US and Canada. What we have to expect as of mid of January, China basically will be closed for 2 years. There will be less demand and, of course, less transportation as well. On the longer term, we believe China will stay the factory of the world. Yes, there might be some shifts, but China is and will stay to be the big factory for the global citizens.